This metal just shattered a 44-year ceiling, every solar panel being installed, every electric vehicle rolling off production lines, every data center powering artificial intelligence. They all need one thing: silver. And for the 5th consecutive year, we're consuming more than we're mining. Not theoretically. Right now. In real time. In the next 12 minutes, I'm going to walk you through the structural forces driving silver to all-time highs above 57 an ounce. I'll show you the supply-demand imbalance that's accumulated to 820 million ounces of cumulative deficit since 2021. And I'll explain why silver's price action in October 2025 revealed something the market hadn't seen in decades: a physical squeeze so severe that borrowing costs in London hit 39% annualized. Let's start with what just happened. In late November 2025, silver broke above $57.86 per ounce. That's not just a number, that's silver finally exceeding its 1980 peak, its 2011 peak, levels that had capped this metal for over 4 decades. In 1 year alone, silver has risen roughly 85%. And the fundamentals suggest this isn't speculation. This is recognition. Here are the numbers. According to the Silver Institute's 2025 report, global silver demand reached 1.21 billion ounces in 2024. Global mine supply, 813 million ounces. Flat. That's a deficit of 149 million ounces in 2024 alone. In 2025, the deficit is projected at 95 million ounces. That's 5 consecutive years of structural shortage. The cumulative deficit from 2021 to 2025 totals nearly 820 million ounces. That's equivalent to 10 months of total global mine production consumed beyond what the Earth produced. Where is all this silver going? 3 words: green energy transition. Let me break this down. In 2015, the photovoltaic industry consumed 60 million ounces of silver. In 2024, that number hit 232 million ounces. That's a 287% increase in less than a decade. Silver paste is essential for capturing electrons in solar cells. Its conductivity is unmatched. No commercially viable substitute exists at scale. When sunlight hits a panel, silver carries the current. The International Energy Agency projects over 4,000 gigawatts of new solar capacity between 2024 and 2030. That's 80% of all renewable energy expansion. China is installing 60% of it. Every megawatt requires silver. And while manufacturers are aggressively reducing silver loadings per panel, down roughly 20% in 2024 alone, the sheer volume of installations is overwhelming those efficiency gains. Then there's electric vehicles. An internal combustion engine uses between 15 and 28 grams of silver. A battery electric vehicle uses 25 to 50 grams, nearly double. Silver's conductivity makes EVs more efficient by establishing lightweight but powerful electrical connections between batteries and motors. The automotive sector is projected to consume 90 million ounces of silver in 2025. And as autonomous driving expands vehicle complexity, that number rises further. Add artificial intelligence infrastructure, data centers, 5G networks, medical devices, consumer electronics. Industrial silver demand hit a record 680.5 million ounces in 2024. And here's the structural problem. You can't just mine more silver. Roughly 70 to 80% of global silver production is a byproduct. You mine zinc, you mine lead, you mine copper. Silver comes out as a secondary output. You cannot simply increase silver production by raising prices. You'd need to expand base metal mining globally. That takes capital. That takes permits. That takes 7 to 10 years. And base metal prices are volatile, discouraging new investment. Primary silver mines account for only about 28% of supply. And even those are seeing declining ore grades. You dig deeper. You process more rock. You get less silver. Mine supply has declined 7% since 2016. It's not growing. This creates what economists call inelastic supply. Demand surges. Supply cannot respond. The only adjustment mechanism is price. Now let me explain what happened in October 2025, because this revealed the structural fragility. In early October, a squeeze developed in London's physical silver market. The London Bullion Market Association is the world's largest over-the-counter precious metals trading hub. Silver borrowing rates, normally negligible, spiked to 39% annualized. That's a cost to borrow physical metal that signals severe scarcity. What caused it? A combination of factors. Strong physical buying from India, where silver prices hit record highs in rupees. Exchange-traded funds accumulating metal, industrial users securing supply, and a lack of readily available inventory in London vaults. The situation became so acute that silver had to be air freighted from the United States and China to London. Air freight for silver. That's typically reserved for gold. Approximately 15 to 20 million ounces of silver, around 400 to 600 tons, were shipped to London in a single week to ease the squeeze. During this period, spot silver hit $54.47 per ounce, a record at the time. Prices have since climbed higher. The squeeze eased, but didn't resolve the underlying issue. Most silver inventory in London vaults is already allocated to ETFs. It's spoken for. The available float for physical delivery is thin. On COMEX, eligible silver inventories have seen 33 million ounces of outflows since mid-October. Metal is leaving the system. Open interest in silver futures grew 35% by November 2025. Traders are positioning. This is what happens when paper markets meet physical reality. For years, traders could satisfy silver exposure through futures and derivatives. But when industrial users need actual metal, when solar manufacturers need paste, when automakers need components, paper contracts don't conduct electricity. Physical silver does. Let me address the counter-arguments directly, because nuance matters. Substitution. The solar industry is aggressively reducing silver loadings per panel. They've cut usage by 20% in 2024. Copper-cored silver pastes are being developed. This is real, it extends the timeline, but it doesn't eliminate silver's role. Silver remains the most conductive element on the periodic table. At utility scale, efficiency losses from alternatives translate to billions in lost output. The thrifting is happening, but installations are growing faster. Recycling. Silver recovery from electronics is below 20% globally. E-waste is the fastest growing waste stream on Earth, yet only 15 to 20% of discarded electronics are formally recycled. The silver content per device is too small to make extraction economical in most cases. Solar panels last 25 to 30 years. That silver isn't returning to market soon. New mining supply. It takes 7 to 10 years to bring a significant silver mine online. Current capital expenditure in silver mining is at multi-decade lows. No major new supply is coming in any time frame that addresses the current deficit. And remember, most silver comes from base metal mines that won't expand just because silver prices rise. Demand destruction. The only scenario where silver demand collapses is if the energy transition reverses. But the transition is policy. Trillions in subsidies committed across the United States, Europe, and China. The Inflation Reduction Act, the European Green Deal, China's dominance in solar manufacturing. These are structural forces, not cyclical trends. Now let's talk about what silver's price action is telling us. Silver has doubled in roughly 12 months. It broke through resistance levels that held for 44 years. The October squeeze demonstrated that physical tightness is real, not theoretical. Premiums in India hit unprecedented levels. London couldn't source enough metal without emergency shipments. But here's what's important. Silver isn't just industrial, it's also monetary. For 5,000 years, silver has functioned as money. Gold gets the headlines, but silver was the primary circulating currency for most of human history. It's the only major commodity that simultaneously serves irreplaceable industrial demand and stores value as a monetary metal. When central banks print currency, when governments run deficits, when inflation erodes purchasing power, investors historically turn to hard assets. Gold has rallied significantly in 2025. Silver has outperformed gold. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, spiked above 100 earlier this year. Historically, that ratio averages closer to 60. A ratio above 100 suggests silver is undervalued relative to gold. Now consider the convergence. Industrial demand at record highs, supply structurally constrained. Investment demand rising as central banks ease monetary policy. The Federal Reserve has already cut interest rates twice in 2025, bringing the federal funds rate to the 3.75 to 4% range. Markets are pricing an 80% probability of another cut in December. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. Industrial bid meets monetary bid. Solar manufacturers compete with ETF inflows. Automakers compete with investors. India competes with China. When everyone needs the same finite resource and supply cannot respond, the adjustment is price. Here's what you should understand. The current situation is not a prediction about the future. It's a description of the present. 5 consecutive years of deficit. 820 million cumulative ounces consumed beyond production. Record industrial demand. Flat mine supply. A physical squeeze that required emergency airlifts. All-time high prices. The market isn't anticipating a shortage. The market is responding to a shortage that already exists. Does that mean silver goes to $100? $150? That depends on variables no one can predict. Geopolitical events, policy changes, technological breakthroughs, economic cycles. Markets overshoot, markets correct. Volatility is inherent. What the data shows is this. Consumption exceeds production. Inventories are depleting, industrial applications are growing. Supply cannot respond quickly. These are structural conditions, not temporary imbalances. If you want to understand this market, do your own research. The Silver Institute publishes annual supply-demand reports. The London Bullion Market Association tracks vault holdings. COMEX reports inventory daily. The data is public. The math is verifiable. This isn't about hype, it isn't about prediction. It's about understanding the structural forces reshaping a market that most investors have ignored for decades. Silver sat dormant while the energy transition built momentum. It sat dormant while deficits accumulated. It sat dormant while inventory depleted. Now it's moving. The question isn't whether the fundamentals support higher prices. The fundamentals already pushed prices to all-time highs. The question is whether those fundamentals resolve or intensify from here. The energy transition isn't slowing. Mine supply isn't expanding. The deficit isn't closing. That's not opinion. That's the Silver Institute's own data. Pay attention. The market is speaking.